Welcome. Today we're diving into the quick ratio, a key financial metric that helps businesses and investors understand a company's short-term liquidity. In simple terms, the quick ratio measures how well a company can pay off its current liabilities using its most liquid assets. This ratio is often called the acid test ratio because it gives a quick snapshot of financial health. Whether you're a business owner, investor, or just curious about finance, understanding the quick ratio can help you make smarter decisions. Let's start by breaking down what the quick ratio actually means and why it matters in the world of business finance. Quick ratio is a financial formula that compares a company's most liquid assets, like cash, marketable securities, and accounts receivable, to its current liabilities. Unlike some other ratios, it excludes inventory from the calculation, focusing only on assets that can be quickly converted to cash. This makes the quick ratio a more stringent test of liquidity than the current ratio. By looking at this number, you can quickly gauge whether a company is able to meet its short-term obligations without selling inventory or relying on future sales. Let's look at the formula. Quick ratio equals cash plus marketable securities plus accounts receivable divided by current liabilities. This formula strips out inventory and other less liquid assets, focusing only on those that can be accessed immediately. For example, if a company has $50,000 in cash, $20,000 in marketable securities, $30,000 in accounts receivable, and $60,000 in current liabilities, the quick ratio would be 50,000 plus 20,000 plus 30,000 slash 60,000, which equals 1.67. This means the company has $1.67 in liquid assets for every $1 of current liability. You might wonder why inventory isn't included in the quick ratio. The reason is simple. Inventory can take time to sell and may not always be easily converted to cash, especially in times of financial stress. By excluding inventory, the quick ratio gives a more conservative and realistic view of a company's ability to pay its short-term debts. This is especially important for businesses and industries where inventory turnover is slow or unpredictable. What does the quick ratio tell us? A quick ratio of 1 or higher generally means a company can cover its current liabilities with its most liquid assets. If the ratio is below 1, it could signal potential liquidity problems, as the company might struggle to pay its bills without selling inventory or securing additional financing. However, a very high quick ratio isn't always better. It could mean the company isn't using its assets efficiently. Context matters, so always compare the quick ratio to industry averages and historical trends. It's important to distinguish the quick ratio from the current ratio. While both measure liquidity, the current ratio includes all current assets such as inventory and prepaid expenses in its calculation. The quick ratio, on the other hand, is stricter, focusing only on assets that can be quickly turned into cash. This makes the quick ratio a better indicator of immediate financial health, especially in uncertain times. Companies with a high current ratio but a low quick ratio may have too much tied up in inventory. Let's consider a real-world scenario. Imagine a retail company with $100,000 in cash, $50,000 in accounts receivable, $200,000 in inventory, and $120,000 in current liabilities. Using the quick ratio formula, only cash and receivables are counted, so the quick ratio is $100,000 plus $50,000 slash $120,000 equals 1.25. Even though the company has a lot of inventory, the quick ratio shows it can still cover its short-term debts with its most liquid assets. This example highlights why the quick ratio is so valuable for assessing financial stability. While the quick ratio is a useful tool, it's not perfect. It assumes that accounts receivable can be collected quickly, which isn't always the case. Some companies may have trouble collecting payments from customers, which can distort the ratio. Additionally, the quick ratio doesn't consider the timing of cash flows or upcoming expenses that aren't listed as current liabilities. That's why it's important to use the quick ratio alongside other financial metrics for a complete picture. Wrap up, the quick ratio is a powerful yet simple measure of a company's short-term liquidity. By focusing on the most liquid assets, it provides a clear view of whether a business can meet its immediate obligations. Remember, a healthy quick ratio is generally above 1, but always consider the context and industry standards. Use the quick ratio as part of a broader financial analysis to make informed decisions and better understand a company's financial health.